As with anything worth doing, in the commercial real estate space, there are levels to this game. And today we have a guest who is operating at a very high level and has been for quite some time. So, very experienced operator, really a pleasure to speak with someone who takes the business as serious as I do and just really looks into the details and really is willing to be open about the fact that market dynamics change for sure, but our own perspectives as investors change. In this conversation, we'll talk about how there are things we thought 10 years ago that I won't say they're incorrect, but that our strategies and perspectives on these very important topics has changed significantly. I think it goes to show you that every year you need to be a better investor. You want to be a better investor this year than you were the year before. You want to be a better investor next year than you were this year. And once you do that every single year, if you're constantly trying to upgrade, you're constantly trying to increase your knowledge and increase your network, when you look back on 10 years, you'll undoubtedly have made some, I don't want to say mistakes, but done things you wouldn't do now. So that's the mark of a good investor, and that's the mark of exactly what our conversation is like today. So in this discussion, we're going to talk about why our guest strategies have changed pretty significantly from going from Class C and Class B multifamily early in the cycle to now almost exclusively focusing on purchasing Class A product. We're going to talk about communicating to investors in today's economic and social climate. Obviously, there's new information coming around COVID every single day, minute, week. And so if you're just issuing quarterly reports, it may not be adequate. In fact, the statement that we both make is that you likely can't over-communicate to investors in this environment. And we're going to have a conversation about debt. We're going to go through a lot of details about debt. Most importantly, how both our guest and I's perspective about floating rate financing versus fixed rate financing has changed pretty significantly, and looking at the totality of the global capital markets, why it might be wise to contemplate some floating rate debt going forward. Now, you can close your eyes and not pay attention to this conversation when it comes to that particular topic, but I think you'll be leaving money on the table. I really do. So, hope you enjoy it. Now, here's the thing. Our podcast is totally free. We don't ask for outside advertisements. I've never been paid to put an advertisement on the program, but we ask for one thing, and it's a symbiotic request, which is a review. Now, a lot of you have been sharing the show. I know that a lot of you have been posting on social media, and I'm so appreciative of that. In fact, we recently crossed the top 200 in iTunes in the investing sector, which is an incredible accomplishment, something that my team and I have been working towards for quite some time. So congratulations to you for doing that. That's the reason that we have done that. But the best way to give back to the show, if you really like the show, is to go to iTunes, scroll down to the bottom of the Cashflow Connections Real Estate Podcast, and take 2 seconds to leave a review. It is so appreciated because in a world where a 2-minute review can slowly add up to 100, 200, 300, 400, 500 reviews, it allows us to attract really high-quality guests, high-profile guests that are trying not to do a bunch of speaking engagements or shows that don't get a lot of traction. This show does, and I really want it to be able to stand out. And the easiest way it can stand out is just the number of reviews. So here's the bargain. Free content for life. We've done over 200 episodes. Congratulations on that too, by the way. If you listened to 3 episodes and you enjoyed them, do me a favor, head over to iTunes and leave a review. 3 episodes is the cutoff. I'm half joking, but if you've enjoyed 3 episodes, do us a huge favor, head over to iTunes, scroll down to the bottom, 5-star review, make it honest. Whatever you like about the program, it will be greatly appreciated. If you like one particular episode, if you like one particular topic, regardless, whatever. So appreciative of you guys. Thank you so much. Hope you enjoy the episode. How's it going, everyone? Our guest for today is Michael Becker, who is a principal over at SPI Advisory. They have overseen and purchased about 12,000 units and currently own about 6,000 units in Texas multifamily, about $750 million of assets under management. Michael is also the co-host of the Old Capital podcast, which really is an incredible resource. If you haven't heard that one, we will link to that in the show notes page. Michael, thanks so much for joining us.
Hunter, thanks for having me on. I appreciate it.
So this is obviously an interesting time to be in the world of real estate. I don't want to date this podcast too much because we have been talking about COVID, but I think there's a question that a lot of people that own real estate and a lot of people that are investing in real estate are asking right now, which is from an investor relations standpoint, how do you manage this in terms of reducing anxiety, but also in terms of being transparent? What are your thoughts on investor communication generally, and then also specifically as it relates to this particular challenge?
Yeah, that's certainly been one of the things I spent the most time on, to be honest with you, Hunter, in the last, I guess we're in eighth week of this, or at least the eighth week I've been at my house. So, in early May as we record this. So there was a couple of stages to that. So the first thing we did really, when we started realizing the world was going to be different and kind of that mid-March, was we secured the health and safety of the residents and the staff on our assets. So shutting down the offices, where the offices are open but shut to the public, closing the common area amenities, trying to get everyone to go to ACH payments, eliminating work orders of the non-emergency variety. So someone punched a hole in a drywall, it's got to wait. But if your AC's out and it's hot, we'll go deal with that. So it's kind of the first thing we did. To the investor communication, the first communication to them was basically explaining what I just said, as well as telling them that we are kind of going to go into a foxhole, that we are cutting off any distributions, which the vast majority of our deals had distributions on them paid out monthly. So we paid out March because that was already in the works by the time we realized what was going on. And starting with April forward, we put those on kind of an indefinite pause, as well as we turned off any sort of upgrade or capital projects that we had going on the property, anything that was kind of currently in the works, kind of past the point of no return. We just kind of finished those off, but then nothing new was going to be spent in an attempt to kind of preserve the capital that the entity had. So that was kind of really the first level of communication. And then, as we kind of got into this a little bit more, we communicated some in March, but then really in April, as we were collecting money, that was a number one priority that I certainly thought about, and I'm sure every one of my investors was getting dollars in the door. So, multiple times a week, I was kind of giving updates on, hey, here's the scheduled rent, here's our current collected, current outstanding, and then we saw that number kind of dwindle throughout April, and we were fortunate enough to collect almost 98% of the scheduled rents out there in April, which was, far better than I think we certainly envisioned when we were kind of in late March heading into April's collections. And then we'll kind of see how May shakes out here shortly. But I think, communicating on a very regular basis and just kind of communicating the most important thing, which is rent collections. And I would then just kind of sprinkle in different metrics like occupancy, or I've been communicating a couple of times our cash balance and our accounts payable balance. So we kind of see our cash net of payables to kind of see our financial health at each one of the entity levels.
Yeah, I appreciate that. And obviously that level of collection is quite favorable for April. I think that different assets, obviously some investors were surprised to hear the national headlines recently that, oh my gosh, a third of renters didn't pay rent for the month of April. And then when you look into the numbers, it's actually not too far off from the national average. A third of renters typically don't pay rent. It's about 75% depending on the product type that you're investing in. But from a investment standpoint, a lot of our investment thesis is about buying mismanaged assets and then basically turning them around, whether it be cutting expenses, whether it be turning over the tenant base. Talk briefly about how recently acquired assets that may be in some state of distress in terms of the tenant base have a different either rate of collection or some kind of different metrics, just given the fact that you're in the process of turning them over versus assets you've had for 5 years.
Yeah, that's key. So there's two things really. There's that, then we kind of span the different grades of market rate apartment complexes. So we started out doing real true workforce. So, Class C, then we transitioned about a lot of B, and here more recent years have been kind of A- to A, but we still have a handful of B and C deals left. So I think generally speaking, the more workforce it is, the more Class C, Class B, generally the higher the delinquency is, and the newer stuff that we own, the lower the delinquency is. And that's, generality. But with that said, to your point and your question is, we had a couple of deals. We bought a deal in December, bought a deal in January. So, two pretty recent acquisitions. Plus we had a deal that was, in the 80s occupied with this completely mismanaged that we bought kind of early fall last year. And so those three deals are certainly a little bit lower in occupancy because we've been in the process of kind of curing the sins of the previous ownership group. by, trying to get in, make sure we have qualified residents in our property, and then turning those units over and doing a renovation plan to upgrade the units and replace them with higher rents with more qualified residents. So we kind of got caught a little bit in the reposition. So a couple of those deals that in particular still have some residents or a larger percentage of the residents held over that we haven't had the opportunity to touch. Those tend to have a little bit more of the delinquency relative to something that I turned the rent roll 3 or 4 years in a row. We clearly have had proper screening and protocols and procedures in place for many turns of the rent roll. So everyone that's on that asset at the time they moved in and or renewed their lease have been properly screened. So they have less collection issues on more seasoned assets.
Over the last 5 years or so, there's been a lot of discussion about the Class A thesis. And I think that's what we talked about last time you were on this show. We saw cap rates in Class C, let's say, or Class B minus go from, let's say, 8% down to 5.5% or so. Meanwhile, you have Class A going from 5.5% down to only 4.5%. So the delta has been much larger in the lower classes, which is typical. And therefore, the argument can be made that the pendulum may swing back further because they have swung in the first place. Is that the reason that you started transitioning from the Class C, B to A? Or now that you've moved into A, are you most likely going to participate exclusively in A regardless of the economic conditions?
Yeah, I think the first part, yes, that was a very similar thought process I went through as we were making that transition was, one, we had some success and we got full cycle on several deals. And so our ability to attract more and larger checks grew. So it's harder to buy smaller, older deals with the amount of demand that we had. So we had the ability to do larger deals, one, and then two, just kind of looking at the marketplace. It just didn't make sense to me in 2017, 2018, 2019 to pay the same or similar cap rates for something built in 1974 that I could for something built in 2004 or 2014. So to me, to pay same or similar cap rates, I would go buy something a little bit nicer, a little bit better. In particular, I really like the A minus space. So in Texas, think of that like kind of late 1990s, all the way to about 2008 and 2009. That was what I would kind of consider A minus. And so a lot of that product was built with white appliances and cheap light fixtures and, not the nicest cabinets, maybe laminate countertops. So it had very similar characteristics. So the 80s stuff from the standpoint that you could go through, spend some dollars, renovate it, and improve the quality of the asset, but it had 9-foot ceilings and typically was in a better located deals. And we had concrete parking lots instead of asphalt parking lots. We had individual HVACs and water heaters versus having, a chiller or boiler system like you might have had in some of the older deals. So to me, that felt like it was a much better buy. And maybe even if the total returns on paper weren't quite as good as maybe a 1970 C-class deal, the way that you would underwrite it, but on a risk-adjusted basis, it certainly felt to be much better. And then one of the other things that was certainly true that certainly helped us out was the options for debt were dramatically better and more robust when we got kind of on the better quality deals where we were doing workforce housing. It was either we're going to do like a bridge loan or we were going to go to like an agency, Fannie or Freddie. Or as we got up in quality, we got, better spreads, one, so we got lower ultimate interest rates. And we got options then to get in a couple of life insurance company loans, which were, even lower on the interest rates. So the debt got better and better, the better quality we got. As far as the future goes, my personal prediction when we start getting into, I don't see, we see a lot of activity kind of coming up. We can talk a little bit more about that. But when the faucet kind of turns back on and deal flow starts happening again, I think really the pain is going to be kind of felt on either end of the marketplace owner. So I kind of use a barbell analogy. So you're going to have the very top of the market. So you have a deal that a developer just built, maybe it's 10 or 50% occupied and the initial lease up. That lease up is going to be very slow and painful for them. So I think that them being in the construction loan with generally shorter maturity, maybe some other covenants that they might breach, I think there's going to probably be some opportunity in that brand new deal buying from developers at a lease up and subsequently maybe on the bottom of the scale as well. So in particular, the older deals, maybe it was a lesser experienced apartment syndicator because apartment syndication certainly came in vogue over the last several years. So there's, many market participants that weren't market participants, even 3, 4, 5 years ago, let alone last, 2 cycles ago, I guess, at this point in the pre-2008 or even through 2008 kind of economic contraction we had. So those people maybe are a little less seasoned, a little less well-heeled financially. And a lot of those guys were kind of chasing these cap rates down, and to make these deals work on paper, they would put high leverage bridge debt on it, typically from some sort of debt fund that maybe potentially could be a little predatory in the way they go about their business practices. So I think there's going to be some dislocation in that part of the market, in particular in the worst located submarkets around the major marketplaces probably would have even further distress in them. So that's kind of where I think the most opportunity is probably likely to first come. So I could see us going, like the song Huey Lewis had, go back in time a little bit and go back to kind of where our roots were, and maybe trying to take advantage of some of the opportunities on the workforce housing space if they arise.
Okay, yeah, I actually didn't know the answer to that question at all, so I'm glad you clarified that. So just to restate it, it sounds like you're willing to intelligently participate from C to A, depending on market conditions, which I really like. And I definitely understand the thesis. I've been a big proponent of workforce and still am, but I can certainly see where you're coming from looking at the cap rate compression, which took place in C compared to A, and just trying to identify a risk-adjusted basis, especially given the liquidity in terms of the options about loans and such that you were just kind of talking about. So let's talk about communication again. I think that there's a lot of people, either investors or owners, that are thinking, when am I supposed to communicate? What am I supposed to share with our investor base, and how frequently do I share that? Now, a lot of owners, especially the old school owners, they may only communicate during a quarterly report. And so their investor base is not used to receiving an email every single week from them. They don't have an educational platform. They simply send out the quarterly report and that's it. How would you anticipate, or how would you suggest an owner that's more on the old school change or modify their communication structure to an investor base that's only used to seeing and receiving quarterly communications?
I mean, I think you said it best. We just actually interviewed you for our podcast, and you said, I don't think it's possible to over communicate at this time. I think that's very true. As a wise word you said, because I think everyone is sitting there wondering what's going on with their money that they invest in these deals, and they have a lot of anxiety and emotions and fears, like everyone does. And the more they're sitting there in the dark, the worse those anxieties and fears become, And I think another thing you said I thought was profound, that bad news doesn't age very well. So especially if you're running into some elevated delinquency and you're having some cash flow issues, and you wait on to tell everyone those issues for 30 days or 90 days, that news gets less well received the longer it is aging. So I would think if you're generally speaking on a quarterly basis, I mean, I would certainly step that up at minimum to a monthly basis. And, maybe don't need to necessarily send out, detailed financial reports or go as detailed as I tend to do. But, I think having, collection updates on a regular basis and kind of giving some communications or maybe, I think certainly communicating collections on an asset by asset basis would be a good thing to do, at least on a monthly basis. Then maybe do like a state of the market type newsletter, what kind of your impression or observations from your portfolio. And you can send that to every one of your investors in a little bit more of a generic form. Would certainly be well received by everybody, because everyone's just sitting looking for new market data and trying to get a nice little bear hug to know that everything's going to be okay. So the more communication you give, I think the better they're going to feel. And then when the time comes to do new deals, I think people that invest with me might invest with, say, you or 3 or 4 of my other competitors. And if we all come out with our hands out to get some money when the time comes to do new deals, I think how you act and how you communicate in this environment will be, remembered for many years going forward from your investor base.
Yeah, I completely agree. Something that I've repeated on this podcast is that the story that you're telling about how you overcame this crisis is happening right now. You're living it out. So just keep that in mind. Your behavior is going to be repeated by you over and over again for the next several decades until there's a more significant crisis or challenge. Think about how many times you've heard people come on and talk about 2008 or 2001 if they were involved in dot-coms. That is what's going on right now. And I think you and I agree that the distress is not likely going to result in that death spiral of lack of liquidity that we saw in 2008. But regardless, when times are tough, you actually get to find out who you are as a person, and your investor base is going to find that out as well. So please act accordingly. So let's talk about kind of property specific management. This is a little bit outside of my area of expertise, but I'd love to hear some of the things that you're doing in terms of on-site management, in terms of, proactively reaching out to tenants and discussing their situation, opening the office doors, allowing them to come and talk about what's going on so that you have a heads up if they're going through some kind of, tenant specific, unit specific distress. What are your thoughts on asset management right now?
Yeah, we certainly try to get ahead of this as best as we could. So as people reached out to us, we logged every communication that we had about lost a job, cut back of hours, things along those lines. We tracked that by unit at each one of our properties. So we had a pretty good sense of that. And as we were getting into April collections, we went back and looked at the prior 3 months and saw where we were, where each resident on average for the previous 3 months had paid us. So certain residents prepay their rent 8 or 10 days ahead of time, and some pay it on time, and some habitually pay, 7, 8, 10 days late every single month. So as we started getting into collections, we would go down and see who was kind of out of their normal pattern. And then it was kind of that was where we started to prioritize who we would contact first. So if they hadn't communicated us about a job loss, and they normally pay their rent on the second of the month, and here we were on the 5th of the month and they hadn't paid us, they were getting a phone call from us with us reaching out to them to understand what was going on. And we purposely kind of let the toolbox on the on-site level be kind of barren of tools when we first started getting into collections. We didn't want to give the staff kind of the latitude to do, let's make a deal. We took a more uniform approach on payment plans. Since all the courts had kind of frozen up, there was no options to evict any residents, and there still isn't as we currently talked, and it probably won't be for another couple of months on the best case scenario at some of the assets. So we wanted to go more standardized on our payment plans, where it's basically like a 25%, 50%, 25% over a 3-week period to get these people to kind of get a little bit more uniformed. And then as people fell off of that, that's what we'll then kind of cut a little bit more one-on-one type of deals down the road. But we just wanted the staff to kind of make sure that they communicated that, rent's due on the 1st. We expect you to pay your rent. If you're having income and disruptions, please reach out to us. We'll work on a payment plan. That, with the benefit of hindsight, at least for April, worked reasonably well. One of the things I heard a lot of people say, which I kind of disagree with, I thought was a poor idea. Some of the people I listened to on podcasts were talking about, hey, in late March, I'm going to all my residents saying, if you pay April's rent early, I'll give you $50 off your rent or 5% off your rent or whatever it was. That just didn't make sense to me, Hunter. I mean, because what the residents that would have taken you up on that are probably already your responsible tenants, the people that were going to pay you, whether you gave them a concession or you didn't give them a concession. And the people that weren't going to pay you on time were never going to be the ones you giving them $50 off is never going to entice them to pay you anyways early. So I think what they did is they took some of the cash that they needed, we need more desperately today than any other time in recent memory. And they gave a concession to the people that are going to pay their rent on time anyways. So to caution people to think about maybe not doing that so early in the month, because you're probably just incentivizing already responsible people to pay your rent anyways, which you're just giving away cash.
Understood. Speaking of cash, let's talk about reserves. It's very difficult to underwrite this situation. And I've been asked this question several times, and I haven't been willing to really speculate on a numeric or percentage basis, which is the basis most people think about reserves. But maybe you are. So I'd love to hear your concept of reserves right now in a post-COVID world. And how are you looking at this, whether it be a portfolio basis or an asset-specific basis?
I haven't given too much thought on the new acquisition, so I probably need to think about it. But maybe a guideline that kind of is out in the marketplace is, virtually all the lenders are kind of frozen and not lending anymore, with the exception of Fannie and Freddie. And Fannie and Freddie are out there lending. I don't think they really want to lend, but they have a mandate since owned by the government that they have to provide liquidity in the marketplace. So what they are doing is if they do loan to you, they're basically giving you no policy exceptions to their credit underwriting standards, and they're overlaying some additional escrows that they're making you put on these assets. So kind of depending on the tier and the leverage you're getting, but generally they're requiring an additional 12 months of PITI payments and escrow. So your principal, interest, taxes, and insurance on top of your normal escrows are going to make you escrow an additional 12 months until you kind of can prove for 2 quarters that you hit a certain debt service coverage ratio and we're out of the national emergency declaration, that's when they'll release those monies back to you. So that's probably a reasonable starting guideline, Hunter, to think about is, maybe 12 months of PITI, or at least maybe 12 months of P&I payments set aside in escrow. And then maybe if it's a better stabilized deal, doesn't have quite as much distress within it, maybe you can scale that number back to 6 months to 3 months or something along those lines as additional reserves on top of whatever capital improvement money you need to set aside, as well as whatever your normal working capital would have been. So that might be kind of a general starting point as we start thinking about the next deals that we do.
Yeah, that makes sense. What about deals you already own? Would you feel like that would be also reasonable given, let's say, 3 months, 4 months, something like that?
Yeah, I would think that's probably not a bad idea. I mean, one of the things, like I mentioned, we turned off all distributions. So we got through April. We're in the beginning part of May collections as we talk currently. And then I was going to get through, probably till middle of June before I even kind of look up and see where we're at. And kind of once we get through June's collections, we make our June mortgage payment. I'm going to kind of see where my cash position is relative to payables, and then kind of see where everything else, all the other metrics as far as collections and our revenue and kind of what the world looks like, in a few months from now before I kind of determine when do I want to turn those on. But I probably will need to look at some sort of mortgage payments and have several months of mortgage payments set aside before I decide what level of cash distributions we want to start turning back on. I don't know if we'll just go back to pre-COVID levels. I would imagine that we'd have to rerun all those and probably start a little bit more modest and always can build on it. The good thing about it is this cash isn't, if we don't have a need for it, it's not going anywhere. It's just sitting in our operating account. So if we kind of get the all clear sign, or when we get the all clear sign, whether that's, in a few months or a few years, that money will be there and available to distribute out to all the investors.
Yeah, I appreciate the transparency about that. And I think that it's wise. And obviously, I think it's an important, circling back with our conversation about communication, that's totally understandable if you're painting the picture clearly. This is an effort to be conservative. This is the right thing to do for investors' best interest over the long term. And here's some of the underwriting assumptions we'll be using when we do start to make those distributions. I think that's a very good way of kind of communicating that. Let's talk about kind of looking forward. You mentioned you're not really contemplating going into any contracts right now. What do you anticipate this is going to look like from a deal flow perspective? And if you do anticipate distress, what kind of distress are you anticipating later down the road?
Yeah, my crystal ball, and we'll see how clear it is in a little while when we have the benefit of hindsight. But right now, I mean, there's virtually no transactions going to happen in the second quarter. Certainly anything that wasn't probably already set or almost set kind of pre-COVID. I think those deals might be we're kind of seeing the tail end of those deals kind of close right now, the last handful of them, but I mean, any current owner that doesn't have distress would be clinically insane to go to the market right now to try to sell their deal. Cause it's just so much uncertainty. Everyone that doesn't have distress is just kind of hunkering down, waiting, and then we'll reassess down the road when a better time to go to market is. So only the deals that would go to market would have some sort of compelling reason to sell. So that's kind of what we're seeing. And I think with most of the lenders in the process of giving forbearance, specifically in the multifamily space, which I play in, the agencies, Fannie and Freddie, were the two largest lenders. So if needed on a case-by-case basis, they're allowing 90 days worth of payment forbearance or 3 months worth of payment forbearance. So if you think about it, if you're in trouble and you can't pay your bills, you can't pay your mortgage, the agencies are going to give you a 90-day lifeline. So most people were able to cobble together April. So, even the earliest ones most likely are going to be May, June, July. And then when they come out of it, then if they still can't do it, that's when those deals maybe start having distress. So I don't really see a whole lot of transactions happening in the near term. I think kind of use an analogy, in particular, very true with a lender, like the faucet was fully on as we kind of went into 2020. And the faucet doesn't turn off slowly, it turned off immediately, but it takes a little while to turn back on. So I think probably that third quarter, we see a couple of drips coming out of the faucet of some deals happening. I think by the fourth quarter, there might be a small little trickle. And then probably in 2021 forward for 12, 18 months, we probably see a pretty decent flow, a stream of some of the deals that got, market pricing reset. And then I just don't know exactly how long we stay low. I mean, last time it was probably 4 or 5 years where you could have bought in 2009 all the way to 2013, 2014 with pretty low attractive cost bases, relatively speaking. And it really was probably 2015 forward when prices really started kind of accelerating from a per unit, per foot kind of standpoint. So I just don't know if we have quite as long of time here because the Fed is certainly responding in a much more aggressive manner with the amount of money they're printing and injecting into the system, as well as the Powell's pledge to keep the interest rates low for basically the foreseeable future. I think the combination of those two things at some point will maybe not cause consumer price inflation, but I think it will flow into the asset price appreciation. And I just don't think we have 4 or 5 years of this downturn. I think due to those two factors, I think the asset prices will rebound, relatively quick, and call it probably 2 years would be my best guess at this moment in time.
I know this is a bit of a crystal ball question, but what are your thoughts on cap rates in the wake of this? Do you anticipate a pretty significant expansion? If so, how much?
I think I'll give a direction or kind of versus property grade, and then I'll talk a little bit more about it. But I think as far as, earlier in our conversation, we talked about how, in the beginning of the cycle, a brand new Class A deal in Dallas was maybe like a 5 cap and a C deal was like 8 or 8.5. And then they fell on top of each other or almost on top of each other 2018 through the first quarter of this year, which is why we kind of traded up in quality. I think that the top of the market will be a little stickier and the bottom of the market will expand a little bit more. So that gap shouldn't be 50 bips, 100 bips. That gap should be 300 or 400 bips. So I think the A will be a little stickier and the C and the Bs will expand a little bit more. So I don't know to what level. I think with the deals that transact in the next, year or two, I don't know if really cap rate's going to be the best metric to look at it, because if these deals are distressed and their occupancies are really much lower and their collection loss is much higher, cap rate metric really isn't the best way to value those. Those are going to trade on a per pound type of basis. And I think the people that are, not distressed just won't sell. So I don't think you're going to see a whole lot of non-distressed sales to kind of identify the cap rate expansion that we're going to see. I do expect to see some, but with, I think, the rates being as low and pledged to be as low as they're going to be, I think in 2-3 years from now, I really don't see material long-term expansion of the cap rates so long as the Fed keeps the interest rates low. Because, we have a couple, we're fortunate with a couple of deals we did in 2019 that we put some debt on, and we have, LIBOR plus, we have one loan at 156 over LIBOR, one at 158 over LIBOR, and several in that 180 to 190 spread over 30-day LIBOR. And as we talked today, 30-day LIBOR is like 33 basis points. So I have a couple of loans with a 1% handle on starting of an interest rate, which is absolutely insane. So if we have an environment like that, which I know spreads have certainly widened out, we can talk about that if you want. But, I don't see how we can see cap rates run too far away in kind of medium to long term.
That right there is just so important for people to understand. That is pretty much the name of the game. I think when people have been contemplating over the last decade, how low can cap rates go, or even saying the other version, when are interest rates going to rise and how are we going to be investing based on that thesis? If you have been investing based on a rising interest rate environment, I don't want to say that you've been investing incorrectly, but you've certainly left money on the table. It may be a more conservative strategy, but what he is outlining is the mathematics of how cap rates and interest rates actually interface with each other. And looking at the reality of the tone of the current economy, as well as the tone of the Federal Reserve Board, I think the reality is we are in for a low interest rate environment for the foreseeable future, and I could mean decades on that, and a lower cap rate environment in turn. Also, you mentioned that cap rates may not be the best way to value real estate. I totally agree with that. I think that, real estate trades at a multiple of income. If that income becomes unreliable, that metric is no longer a vehicle for price discovery. So I think the term per pound basis, every now and then a guest comes on and says a phrase, and then I repeat it for the rest of my life as if it is my own. I'm going to go ahead and repeat that because I think that's fair. I think that's a good way of putting it. Cost per door, for example.
Or if you have a retail strip center and it's, went from 80, 90%, of paying tenants to 100% vacant, you can't value that on a cap rate basis. It just doesn't make sense. It's going to be relative to replacement cost. And a few other metrics. But yeah, per pound will certainly be the way. In particular, a lot of like the hospitality and or retail stuff clears.
So I want you to circle back regarding the spreads. You said, the spreads are changing significantly. Let's talk about it. Let's talk about interest rates and cap rates. And particularly, there's been a lot of talk about the interest rates of multifamily not really corresponding with the interest rates in the single family space. What's your thought on that currently? And do you anticipate that that's going to be eliminated, the spread between the two?
I don't follow the single family space quite as closely or well, but, I think, certainly, your interest rate really is based off of index plus a spread when you're getting a commercial real estate loan. So those change over time. So kind of what happened or here over the last couple of years, what had happened was we were seeing back in 2018, the Fed was trying to wind down this balance sheet. They were trying to normalize interest rates. They started doing interest rate hikes. So I think we got five or six quarter interest rate hikes over the year, or maybe 18 months. I think it started back in late 17. And so we were seeing the interest rates go up. So the 10-year treasury, which is how if you take most of the commercial real estate that is fixed, is based off the 10-year treasury plus a spread. So we started seeing the index go up, and then correspondingly, we were seeing the spreads kind of come down. So the all-in rate didn't move too terribly, but it's kind of started in that low fours and went up to about the 5% rate for 10-year money, generally speaking, on a Fannie Freddie. And then all of a sudden, in the late fourth quarter, the stock market started diving of 2018, and then the Fed reversed course and started cutting throughout 2019, the overnight rates, and then the Treasury started following along the way. But the spreads didn't expand immediately. So we were able to kind of arbitrage that both on fixed rate as well as on the floater. So we had these really, historically low spreads that we were able to kind of lock in. And our thought process was, because I certainly have a battle scars of tens of millions of dollars of yield maintenance or defeasance on fixed rate loans I put on that we try to sell, that when we sold, we had to either take a lower price to sell on a loan assumption, or we had to suck up and eat the prepayment penalty on those deals. That we decided we're not playing that, and we could just take it a LIBOR-based adjustable loan. And the interest rate caps were exceedingly inexpensive the last couple of years because Powell and the Fed were cutting rates, and the market's expectation of interest rates were to be low for a period of time. Now we're in the economic contraction that we're in. They're further expected to be low. So if anyone ever wants to Google like something interesting, just Google the forward LIBOR curve or the forward 10-year Treasury curve, and the expectations for the next 10 years of LIBOR is not going to crack, I think, about 85 basis points at this point in time is what the market expectations are. So that tells you how the market is expecting for pricing to be. So you can get a floating rate loan and, buy a really affordable rate cap. But as we saw these shocks here recently, Hunter, what we noticed where the LIBOR was falling, the Treasury was falling, but lenders were pricing in the risk in the marketplace. So the spreads were expanding commercial real estate before everything kind of froze up. So what was 150 basis points for us or so 12 months ago would be probably 300 or 350 basis points over LIBOR today if we're able to get a loan. So that's kind of the component of the risk that the investors in the marketplace are. And then the high yield corporate debt bonds, those spreads just absolutely exploded for a month or two before Powell started buying everything in the world. Every debt instrument in the world tried to stabilize the debt markets.
Yeah, so much knowledge in there. I think that your conversation about fixed rate versus floating rate, if you're interested, I did a quick Monday Minutes if you're listening to this, fixed rate versus floating rate ASIM capital. If you just Google that phrase, you'll get a quick summary of my thoughts on this. And, to be honest with you, early in my career, I, similar to you, thought that fixed rate was the most conservative. I'm locking in this rate. I don't have to worry about the interest rates from this point forward. The challenge is because the lender is incurring interest rate risk in that environment, they basically stipulate that you have to have the loan for a certain number of years. And if you want to pay the loan off prior to that number of years, you have to pay a big penalty. And we too have paid those penalties. So I don't know that it's just floating rate going forward, but I think a good combination of both gives you a diversified approach, which generally speaking, if both strategies are valid, from an investor perspective, diversification is usually a very good thing. So just my quick thoughts.
Can I add to that
Absolutely.
before you move on? I think, honestly, we had the exact same philosophy. We might as well have been talking to each other back then, even though we weren't, but we were thinking that, rates will eventually go up. This is more conservative, which in theory it is, but what's turning out to be reality is, say the deal I put on last year, that was a 156 spread over LIBOR, where my current pay rate's going to be like 190, give or take, or something like that, right? I mean, really sub 2% interest only. Compare that to a loan that we put on. We got stuck in December of 2016 when the election happened. We were putting a deal together. We weren't rate locked, and the rate started out the low fours. And by the time Trump got elected, the rates were all rising. We couldn't lock it until about 490. And so we had 3 years worth of interest only. Now that loan is now converted to amortization. So my monthly mortgage payment, or what we'd call your debt constant, your amortizing mortgage payment, would be equivalent of like, say, a 6 or 6.25, the debt balance paid annually. So, for per dollar of debt on the deal I put on in 2016 versus a dollar of debt I put on the floating rate deal last year, I'm paying basically 3 times my debt service relative to what we are today. And today, when your income stream potentially could be impaired just due to your tenants losing their jobs, it's honestly more conservative putting that floating rate on it, as crazy as that sounds. And that is a complete paradigm shift from what I thought, as recent as, 4 or 5 years ago.
Yeah, completely agree. And this is just something that you need to talk about. Look, every year, my goal is to become a better investor. So I didn't have it figured out 10 years ago. I didn't have it figured out 5 years ago. I didn't figure it out this morning either. That's one of the reasons I like to have these conversations with other savvy investors, is so that we can learn together. And now an important part of that conversation as well is that concept of a rate cap, which will come at a premium. But then you really start to realize that if you can have a ceiling on the interest rate, which you have to pay for that ceiling, now you, as an investor, have more tools in your tool belt. Now you can understand the world of investing much more holistically and can make decisions on a much more educated basis. So I really like that conversation. I know we're getting a little bit nerdy for the people at home, but this is actually important, especially when you're talking about managing $750 million worth of multifamily, making big decisions going forward. So I appreciate you going to that level of detail. Real quick, let's talk about underwriting right now. You're not transacting in today's environment, but how do you anticipate your underwriting changing looking out into Q4, Q1 of 2021?
I think on new deals, I'm not quite sure exactly, but what we try to do our best to sensitize, and we're going to re-sensitize everything kind of on our existing portfolio. So we took some broad assumptions on collections as we're kind of in late March going into April, May, June, and kind of throughout the rest of the year. So, our base case was that we were going to have, I think it was like 15% economic vacancy in April and going to low of 25 for, I think, May, June, July, and start kind of recovering back through the rest of the year. So we try to look at it from that standpoint and sensitize where our cash position would be. And do we have enough cash to kind of make sure we keep our lights on and pay our bills? So that's certainly one thing we did. I think on new deals, so much of this is really lender driven. That is so hard because right now, you would have to underwrite with 12 months of PITI of additional escrows if you're doing a deal, and then you probably underwrite lower loan proceeds than you certainly would have a little while ago. So it's challenging to really kind of tell you I'm going to underwrite in 6 months from now, because right now you'd have to underwrite that 12 months of PITI. So you're probably talking 7 to 8% of your principal balance as additional reserves today that you wouldn't have had 2 months ago. So it's really going to make these returns kind of a little bit funky. So, I think then Fannie and Freddie really only work for kind of stabilized type of deals and don't really work for distressed deals. And I think the only deals they're going to trade are going to be stressed. So what I think is going to happen is what I used to do for a living is going to come back into vogue, which is recourse bank debt. And that's been, a nasty word that I certainly didn't want to ever go down the path of taking on as an investor. But, that's how a lot of the deals cleared in 2009, 2010, 2011. Was the deal was broken. They came to someone like me when I worked at a bank, and they would sign a guarantee to go in, buy the deal, rehab it, and get it on the back end. Because me as a lender, I had an asset that didn't quite have historical track record to be able to produce income. So we needed to lower the leverage a little bit and have a secondary source of repayment, which would be the balance sheet of the guarantor of the loan. So I think that's really how these things are going to probably trade. And that's probably what we're going to have to underwrite to, is some sort of recourse debt. And or potentially, if you can find a deal that maybe you can go assume a mortgage from a Fannie, Freddie, Mac lender, and then basically you come in with no equity really as down payment. You just have to raise for working capital for deficit cash flow plus any sort of CapEx. And that's probably a handful of deals can go that way as well.
Very cool. So last question, then we'll wrap up. What would you say to someone who has been listening to podcasts for 2 years? They're starting to feel like they're hitting the ceiling. They understand the language. They've secured some strategic partnerships and are feeling like they're ready to transact. What is your suggestion to them during this situation and over the next, let's say, 2 to 3 quarters?
I think what I'm trying to do, and you can apply it in your own way, is really just try to stay relevant. So why I don't expect there to be a whole lot of deals going on. I do want to try to make sure I'm relevant. So earlier today, I had a call with one of the brokers in town that we've transacted with a few times. And we're just kind of trying to just share market information, the whatever new information we have, kind of share what we're looking to do, what we're thinking about doing, talk about a handful of the assets in the portfolio. And then, one day those calls are going to be from just kind of checking in to saying, hey, this guy is willing to sell this asset at this type of price. And then we'll actually have something to talk about that is substantive and proactive. So I think, now that you've got some education and you said that you want to take, everyone's been waiting for the next recession. Well, it is here, and the opportunity, you're kind of on the eve of the opportunity. So it might not be here right now. You need to really kind of focus on calling brokers, talking to them. Honestly, right now is probably one of the better times from the standpoint that they don't have a whole lot of transactions they're necessarily working on. So they would have probably a little bit more opportunity to talk to somebody that they don't necessarily know and try to form a relationship with them. So if you kind of work on that, as well as making sure you guys understand where your equity and debt's going to come from, and communicate to the investors, like you mentioned, maybe send a little newsletter. These are the things that when we do transact, these are the types of deals we're going to look for. These are things we're doing. Communicate with your investor pool, so you're not just going to come one day out of the blue and spring, hey, I got a deal I need to go raise a few $1 million for, and you kind of reaching them cold because you haven't talked to them for a period of 6 or 9 months. I think that would probably be much more well received if you're actively communicating some of the market activities that you're taking as we wait for these deals to start actually transacting.
Awesome. Well, Michael, we obviously covered a ton of ground like we always do when you come on. I really appreciate the attention to detail. I really appreciate the conversation. Before we jump off, let listeners know how they can learn more about you and your firm and your podcast.
Really just, 2 ways to find out information about us. As you mentioned, I co-host the Old Capital Real Estate Investing podcast with all people. So you can find that on iTunes or Stitcher or probably anywhere you hear my voice right now on Hunter's podcast. You can find us or go to oldcapitalpodcast.com. is the website as well. Or the way we operate is a principal and run a company called SPI Advisory. So you can simply go to our company's website, which is www.spiadvisory.com. It's SPI like spy, advisory.com. There's contact us form. I'm always happy to send out some information and start having a dialogue with people that potentially might want to invest with us. And whenever these deals start going again.
All right, Michael. Thanks so much.
Thanks, Hunter.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.